Hello and welcome back to Analysis Review. The Libor rate rigging scandal has rocked the world of finance. Several banks are under investigation, a hefty fine has been handed down, and there have been top-level boardroom departures, most notably that of Bob Diamond, the now former chief executive of Barclays, along with other scandals from the mis-selling of complex derivatives to massive IT system malfunctions. The banking system is well and truly in the spotlight, facing the full forces of political frustration and rising public anger. Joining me now to discuss the case for structural and cultural reform in the banking sector are Philip Augar, a former investment banker himself and now author, and Patrick Jenkiins, the FT's banking editor. Welcome. Philip, start with you. Is Ed Miliband right? Do we need a sort of full-blown inquiry, Leveson style, to look into the banking sector?
Well, we certainly need to ask some more questions, don't we? And I'm very pleased to see the UK taking a lead in this sense. The interesting thing for me, though, is that this is not just a UK issue. In the last few weeks, we've seen, the Libor scandal. In the United States, we've seen a massive case come to court for where banks have been rigging the municipal bond market. And of course, in Japan, we've seen the insider trading scandals and all of the atonement that's been going on there. So, we certainly need something in the UK, but let's keep in mind this is really a global issue.
Right, Patrick, do you have a view? I mean, because there's been a lot of debate about what type of inquiry, if one should have one at all.
I tend to agree that this isn't a UK-specific thing, and maybe I've been watching this sector for far too long, but I feel we know a lot about what has happened. Yes, there are more questions to be answered, but I don't think, personally, that an inquiry, either a parliamentary one or a judge-led one, are really going to provide the answers. If you look at the Treasury Select Committee hearings that we've seen recently, most recently that of Barclays, now ex-CEO Bob Diamond, we didn't really get any answers out of these types of questioning, and I think another similar exercise, albeit a long drawn out one, would be similarly unproductive.
I'm inclined to agree with that. I mean, we know broadly what's going on in these big banks, and it's right that actually governments and regulators are involved. But actually, I'd like now to see the shareholders stepping up to the plate. They own these businesses. We need to have probably structural change and cultural change, and shareholders can drive this. They have to be prepared to accept lower returns in the near term, lower profits and lower dividends in return for a cleaner, more ethical business model.
One thing that we are sort of probably going to see is some form of ring fencing, which was recommended by the Vickers in the Vickers report. I mean, do you think we're going to see more than that now in the wake of these recent scandals?
I really don't see them going any further. Arguably, there's no particular trigger coming out of the Libor scandal that would push you in the direction to say, investment banks absolutely have to be totally separate from retail banks. It's just another reason for the whole debate to start again, but there's actually no concrete reason to reach that conclusion.
Think there's a case for going further? I mean, some people say there's always talked about we need an absolute separation, a sort of Glass-Steagall like.
I think the message coming out of the Libor scandal and the other ones that have occurred globally in the last few weeks is that this is beginning to show you that these massive universal banks they're not only too big to fail, they're clearly too big to manage, and they're probably too big to regulate. And while there's nothing specific in the Libor scandal that takes you down that route, it's yet another nail in the coffin, I think, of the integrated banking model, and I would like to see them split up.
Right, okay. You said too big to regulate. How much of the blame do the regulators need to take for this? Some people are saying, the bankers were allowed to do to do this because no one was watching them closely enough.
Well, two things on that. First of all, the Libor scandal specifically happened under the supervision, if you like, of the British Bankers Association, which is a trade body. So this has to be the final nail in the coffin of self-regulation. That clearly doesn't work. Where were the formal regulators, the FSA and the Bank of England? Well, we were talking here about events in the era of light touch regulation, and I think that's also been discredited.
Just very quickly before we run out of time, I wanted to ask you both about this phrase cultural revolution or change. It's been on everyone's lips. Basically, banking needs to be done differently. I mean, Philip, you actually sort of witnessed cultural change in the city. Do you think it's possible? What needs to change? When people say that, what do they mean? And do you think it's possible?
I did work in the city before Big Bang and after Big Bang. Now, before Big Bang, there was a lot that wasn't good about the city. It was snobbish, it was sexist, it was racist, it wasn't particularly hard-working. But the one thing that was there was respect for the central marketplace. After Big Bang, that appears to have changed. And I think the key driver was money, actually. Once compensation really lifted off, once there were huge incentives to cut corners in return for personal and corporate reward, then the whole thing deteriorated. And I suspect actually what we have to do is somehow break that link between compensation and behaviour.
Right.
I'd agree with that, and I think the changing in regulation and the empowerment of shareholders is actually going to change that, albeit slowly.
All right. Well, lots to discuss in the future, but I'm afraid we've run out of time right now. Philip Augar, Patrick Jenkiins, thank you very much. And thank you for watching. To read more about this and other topics covered by our analysis team, please go to ft.com/analysis. Until the next time, goodbye.